Okay guys, it's Chris with investingwithchris.com, and this is going to be a video over something I think that every investor should at least look into when considering investing into another asset, and that is bonds. What are bonds? We always hear about it. Some people don't even understand how to trade them, or if you're looking to get in that when the market's down, bonds are a good way to at least or try to scalp some of your portfolio and hedge it into, equal, or make it try to be balanced. So bonds usually typically pay 2 to 3% annually. They are a lower profiting asset or something to invest in. However, there is, I don't want to say they're the least risky, but they're often assumed as the least risky. Anytime you put your money somewhere else other than in your own pocket, there is some kind of risk. But to alleviate the issues and complexities of understanding bonds, I hope this little lesson will actually help you out. So let's get financed. First, let's understand what a bond is and how they're used for companies, and then we as investors, how we can basically use them to make money. So Jeff or Joe, the CEO or CFO here, the Chief Financial Officer. The Chief Financial Officer is usually assigned these type of scenarios or the responsibilities to looking for some kind of financing, tracking cash flow, analyzing financial strengths and weaknesses, proposing corrective actions within the company, and strategically growing using investment knowledge and resources. Here we have an objective to raise capital for $250,000 for an expansion of a company building. Okay, so how am I going to find capital or finance the $250,000 that Joe will ask himself? You have a couple of options. We have banks, we have bootstrapping, which is literally just coming up with the money from your own growth and profits. And then crowdfunding, which is looking for other people somehow to chip in and then offers some kind of incentive for doing so. Angel investors, smaller investments, typically $300,000, 20% to 25%. Friends and family, venture capital, larger, 10 million, 25% to 30%. Okay, so that's some of the ways. If we back up banks, bootstrapping, crowdfunding, angel investors, friends and family, venture capital. That are some of the most common ways that CFOs go out and try to gain some kind of revenue or basically come up with financing for other projects. So let's take Joe, the CFO. He's going to go to the bank. The bank will analyze the company's financials, and if all checks out, they will then proceed. So what's the next step? Bank proceeds with the funding by offering 250 bonds. Each bond is given a value of its face or par value of being $1,000. The maturity, which is expiration or the length to which this bond will go out, will be 30 years, and then the coupon rate will be at 10%. The bank offers a rate of each bond for 10% due to risk and the valuation of Joe's company. Its term is for 30 years. The investors then invest in each bond by buying them from the bank. The bank's value of each bond may be $1,005, for example. So typically the bank will sell them for a certain value, and how the bank makes their money is obviously upselling it to a little bit more than the original price. Each investor receives $100 a year for their bond. Bonds are usually paid out in 6-month terms to investors. So 50 times 2 is 100. So how does this process work? We see that the bank lends Joe, the CFO, the money. Joe receives the $250,000 from the bank. Investors buy the bonds. The bank issues the bonds to the investors. Then in return, Joe then pays the investors their 10% throughout the year, 5% in 6 months, and the other 5% another 6 months later, which is $50 semi-annually. And at maturity, each investor gets their initial investment back. The bank is out of the picture unless they cannot sell all of the bonds. Joe would then pay the bank if that's the case. So let's ask ourselves, is it better to issue bonds, which is debt, or resort to financing off equity? And this is where shareholders, people like us, come into stocks and buy shares of companies, and in return we're basically paid with equity. Bonds offers a flat rate or flat return without any other obligation. Shares and stock offer shareholder equity and percentage of company value. This type of capital is only cheaper if the funds fail to increase value of the business. Hope that makes sense. So basically, this type of capital is only cheaper if the funds fail to increase value of the business. So even though the company is selling shares, sometimes they don't grow, and that's where they get to, it's basically cheaper than offering bonds. So who offers bonds to invest in? You have state, local, and federal governments, and then also companies, which is safer. Often companies offer higher coupon rates due to being more risky, whereas the government is safer but less return percentage. Remember that there's always a risk to reward. When there's something more risky, you're typically going to see higher interest rates or return rates and profitability. And then when it's less risky, like state, local, and federal governments, that's where you see those 1%, 2%, and 3% returns, and that's it, because they're less risky. Now, however, there is a misunderstanding when it comes to individuals thinking that the government bonds are 100% safe. So what happens during inflation? Interest rates change and prices change. So here's an example. Those holding a 5% bond, if the interest rate changes or changed to 2%, they will be holding a bond that is higher in value. So someone will be willing to pay you a higher price for your bond to get the 5% rate that you are in. Does that make sense? So if you're holding something that pays you 5% in return, and the interest rates happen to change down to 2%, your bond gets higher in value because guess what? You're getting a higher percentage of return. So they're willing to pay more to get that return. Now, conversely, when interest rates increase, face value or par values of the bonds go down. So you have to lower the price to appeal to consumers to buy that bond. Obviously, if you're trading or if you're getting something that used to be 5% and now it's paying 10%, you're not making as much money than others who are buying them now for the 10%. So you have to lower the price of that bond. Interest rates are increased by the Fed to help slow spending and control rising prices. Anytime there's an announcement that the Fed is increasing their rates, this is why, to slow the spending. If you and I are going out to borrow from a bank or a mortgage lender to buy a house, we're going to have to pay a higher interest rate. So hopefully the Fed says psychologically that's going to slow the spending of the economics and people when it comes to borrowing. So obviously that's control rising prices. So that's pretty much it for the bonds. It's pretty quick. There is one other thing that I want to explain, and that is having bond investments reduce or lower your risk by having a diversified strategy. I said at the beginning of this video that this is why you'll resort to bonds and investing in them. A bond is simply a loan. Companies and governments often offer loans for the ability to pay off its debts or grow projects, and in return issues interest to investors plus the original investment. Bonds are typically more safe when choosing an investment strategy for the fact that they have priority over equity for investors. So remember that. Bonds are getting paid to investors first, and then shareholders for equity are getting paid last. Bonds are calculated with lower interest rates due to the safer investment strategy. Hence, we learn that interest rates are accompanied by risk. The lower the interest percentage, the safer. This again, why those with higher risk or higher debt or lower credit scores, interest rates are higher. Some of the characteristics of bonds include their maturity, their coupon rate, their tax status, and their callability. Several types of risk associated with bonds include interest rate risk, credit default risk, and prepayment risk. This is why I said normally there's not any type of risk, but or at least some people often associate bonds with the 100% risk-free, and that's not the occasion here. They actually do have risk, and that's the interest rate, the credit default risk, and prepayment risk. Most bonds come with ratings that describe their investment grade. Bond yields measure their returns. Bonds are also inversely proportional to interest rates. When interest rates go up, bonds go down. When interest rates go down, bonds go up. So, the maturity. I'm going to go over a couple definitions. The maturity. This is the date when the principal or par value of the bond is paid to investors and the company's bond obligation ends. Therefore, it defines the lifetime of the bond. A bond's maturity is one of the primary considerations an investor weighs against their investment goals and horizon. Maturity is often classified in three ways. You have short-term, medium-term, and long-term. Remember, short-term, medium, and long. Bonds that fall into this category of the short-term tend to mature within 1 to 3 years. The medium-term is normally over 10 years, and then the long-term are generally over even longer periods, 20, 30, 40 years. Open up the calculation and cheat sheet here, if not already. So what I'm going to do, I'm going to go into this cheat sheet for you, look over it, and I'll also provide the link to this in the description. And here you'll see I have created tables for you to understand how to calculate bonds and their definitions. Let me just open this up real quick. So here we have an Apple template. This is pretty good. I've given almost every single thing here for all the previous lessons and videos that I have elsewhere. That's balance sheet templates and forecasting, how to forecast the company, how to find its intrinsic value, so on and so on. The discount cheat sheet and balance sheet and cheat sheet. Basically the definitions and what each section is and how companies generally define their assets and liabilities. But over here for the calculating bonds, I have given you where you can pretty much just fill in the blanks and you'll find the value of the coupon with the number of periods, etc., etc. That's all right here. If you have any questions, always reach out to me. So let's go back to the lesson. Even though it's often assumed that there is no risk for bond investing, that is not entirely true. Remember, I keep stressing this. Bond investors, or sometimes people often say that bonds are risk-free. They do carry a risk due to inflation or a few other things. The interest rate risk. Interest rates share an inverse relationship with bonds. So when the rates rise, bonds tend to fall and vice versa. Interest rate risk comes when rates change significantly from what the investor expected. If an interest rates decline significantly, the investor faces the possibility of prepayment. If interest rates rise, the investor will be stuck with an instrument yielding below market rates. The greater the time to maturity, the greater the interest rate risk an investor bears because it is harder to predict market developments farther out into the future. And that's pretty much the same thing with investing in just stocks. It's easy to say you'll go long term and then anything could change. COVID-19, pandemics, etc., etc. So, the credit and default risk. Credit or default risk is the risk that the interest and principal payments due on the obligation will not be made as required. When an investor buys a bond, they expect that the issuer will make good on the interest and principal payments, just like any other creditor. When an investor looks into corporate bonds, they should weigh out the possibility that the company may default on the debt. Safety usually means that the company has greater operating income and cash flow compared to its debt. Remember this, safety usually means the company has greater operating income and cash flow compared to its debt. That's always a good sign. If the inverse is true and the debt outweighs available cash, the investor may want to stay away. So if there's more debt than operating income and cash flow, then there's an issue there. Just like common sense when it comes to our personal lives or anything that we may invest in. When you look at its debt to income ratio, that matters. Prepayment risk. Prepayment risk is the risk that a given bond issue will be paid off earlier than expected, normally through a call provision. This can be bad news for investors because the company only has an incentive to repay the obligation early when interest rates have declined substantially. Instead of continuing to hold a high interest investment, investors are left to reinvest funds in a lower interest rate environment. So, again, here's pretty much what I went over in that other template. Joe, the CFO, is looking to get financed. He wants to raise capital for $250,000 for an expansion of a company building. Let's just go over a couple of these things. This is in a different format, different visual, but we're basically looking at the banks are always analyzing the company's financials to determine first whether or not they should issue bonds. And then these are the key definitions and terms: face or par value, maturity, and coupon rates. Joe receives the $250,000 from the bank. The bank then issues the bonds to investors, and investors are basically buying at a certain rate while the bank upsells, and then plus the interest rate off of, or not the interest rate, sorry, the upsell off of that is how they profit. Investors do get their full amount after the maturity. Is it better to issue bonds, debt, or resort to financing off equity? This is always a question whether as an investor or even a company business owner, how you should offer ways to grow capital, get capital, whatever. Is bonds or share equity? So, who offers bonds to invest in? As we know it, companies, state and federal local governments. When state and federal local governments are looking to expand, such as building a bridge or whatever, they sometimes resort to bonds. And guess what? That's how they get their money to build that bridge or whatever the case may be for hopefully an improvement within their county or state, so on and so on. Here we go. Inflation again. Remember, interest rates change. Let me just stop that. Sorry. But anyways, interest rate changes. There's always that risk. And so let us understand that most bonds, they're safe for the fact that the company has to pay their investors first from that, and then their investors from the shareholders after. But there is that lower profit margin, 2 and 3% returns. But they are a little bit more safe. So anyways, I hope that helped in understanding how to calculate bonds. I've given you multiple cheat sheets within this lesson, and I've explained how and why CFOs resort to bond issuing. So anyways, I hope that helps. As always, investingwithchris.com, investingondemand.com. Reach out. We'll answer any questions you have within the investment club. And until then, or until next time, happy trading.